Here's a number most people don't know. The Social Security Administration estimates that 1 in 4 of today's 20-year-olds will experience a long-term disability before they reach age 67. Not a fender bender, not a bad week, a disability serious enough to prevent them from working for months, years, or indefinitely. And yet disability insurance is one of the most skipped, most misunderstood pieces of a financial plan. Today we're going to fix that. Think about what your paycheck actually does. It funds your mortgage or rent, your retirement contributions, your investments, your family's lifestyle. Everything in your financial plan depends on your ability to earn. Now think about what happens if that income stops, not for a week, but for a year. Or 5. Federal Reserve data tells us only about 40% of US households have enough liquid savings to cover 3 months of expenses. Only 28% can cover 6 months. That emergency fund is important, but it's not built for this. A long-term disability would drain it and unravel everything else. Here's what we'll cover. The difference between short-term and long-term disability coverage, the single most important policy decision you'll make, how much coverage you actually need, the key features to look for in a policy, and the right time to get it. Let's get into it. Disability coverage comes in 2 types, and they work together. Short-term disability typically covers you for 3 to 6 months after a disability begins. Many employers offer this as a group benefit, and it often kicks in after a short elimination period. That's the waiting period before any benefits start. Your emergency fund is designed to carry you through that gap. Long-term disability is what takes over after short-term runs out, typically after 90 to 180 days. A strong long-term policy can pay benefits for several years, all the way to age 65, or even for life, depending on the terms. This is the coverage that matters most. Short-term handles the inconvenience, long-term handles the crisis. This is the decision that matters most when you're choosing a disability policy, and it's one most people don't think about until it's too late. Own occupation coverage means you're considered disabled if you can't perform the specific duties of your own job, even if you could technically work in some other capacity. That's the protective definition. Any occupation means you only qualify for benefits if you can't perform any job you're reasonably qualified for based on your education and experience. The bar is much, much higher. Here's the practical difference. A software engineer who can no longer write code, but could technically work as a retail associate, would be covered under own occupation. Under any occupation? Probably not. The more specialized your work and the higher your income, the more important it is to have own occupation coverage. For most of the people watching this, that means own occupation. Full stop. So how much coverage do you actually need? Start with what your employer provides. Most group plans replace about 60% of your base salary, and if yours offers this, you should absolutely be enrolled. But here's the catch. Group plans typically don't cover bonuses, RSU income, or any other variable compensation. Here's what that looks like in practice. Say your total comp is $300,000 but your base is $180,000. A group policy at 60% of base pays you $108,000 a year if you're disabled. That's a meaningful step down from your actual lifestyle costs. The target for most people is covering 70 to 80% of total income. A supplemental private policy fills the gap. For healthy people in their 30s and 40s, the premiums are generally very manageable relative to the protection they provide. Not all disability policies are the same. Here are the 4 features that actually matter. The elimination period is the waiting period before your benefits kick in. Common options are 60, 90, or 180 days. A longer elimination period means a lower premium, and it pairs well with a solid emergency fund that can cover you during the wait. The benefit period is how long the policy pays. Options range from 2 years all the way to age 65 or even lifetime. For most working professionals, a benefit period to age 65 is the right benchmark. A COLA rider, cost of living adjustment, increases your benefit each year in line with inflation. This one matters a lot for long-term policies. A fixed benefit that doesn't keep up with inflation is worth less every year you're receiving it. And finally, look for non-cancelable and guaranteed renewable. These 2 provisions mean the insurer can't cancel your policy or raise your premiums as long as you keep paying them. That's important, especially for an individual policy you're counting on long-term. When should you get disability insurance? Here's the short answer. As soon as someone depends on your income. If you have a spouse, kids, or other dependents relying on your paycheck, or if your own mortgage, lifestyle, and savings goals depend on your ability to earn, you should have coverage in place. The need is highest during your primary earning years, when your income is high but your assets haven't fully caught up yet. As you build wealth and approach financial independence, the need decreases, because your assets start doing the protecting. Once your invested assets can fund your lifestyle indefinitely on their own, you're effectively self-insured. Until you reach that point, disability insurance is doing a job nothing else in your plan can do. Here's how to actually act on this. Step 1. Check what your employer provides. Are you enrolled in the group plan? What's the benefit period? What definition of disability does it use, own occupation or any occupation? Step 2. Identify the gap. Does your group coverage get you to 70 or 80% of your total income, including bonuses and variable comp? For most high earners, the answer is no. That gap is what you need to fill. Step 3. Look at a supplemental individual policy with own occupation coverage, a benefit period to age 65, a COLA rider, and non-cancelable guaranteed renewable provisions. Those are your benchmarks. 4 things to remember. Your paycheck is your most valuable financial asset. Protect it. Own occupation, always if you can get it. Aim for 70 to 80% of total income, not just base. And check the features: elimination period, benefit period, COLA, non-cancelable. If this was helpful, there's a link in the description to the full disability insurance guide on our blog. It goes deeper on policy features, how to compare quotes, and how to think about this alongside the rest of your financial plan. If you haven't subscribed yet, we put out a new financial guide every week, practical stuff for people who are serious about